Hi, afternoon, and welcome to the show. Let me begin with a very basic question because, from a stock market investor's point of view, it's very important for us, to break down the Trump 50% tariff, what it means to stock market investor, and also because it's always a push and pull between bull and bears. Should the bears be scared now? Should the bulls be scared now?
Yeah, so like if you look at a very macro basis, US accounts for 2% of our GDP in terms of exports. So, that is the part which will get impacted. Now, within that, around half the exports are not impacted. They're not impacted because, for pharmaceutical, there's going to be a separate tariff, which is going to be equal for everybody. For electronics, there'll be a separate tariff, which will be equal for everybody. Autos are anyway got a separate tariff. Metals has got a separate tariff. So those are not really impacted by this 25%. The other thing we have to remember is it's not applicable immediately, but it's applicable from August 27th. Before that, the US delegation is coming to India. So I guess the idea was that it gives them some, time to maybe strike closer to a deal, in which case it may not happen. But otherwise, for a lot of the other sectors, it will be negative. Most of those sectors center around textiles, gems and jewelry, and some machinery and chemical equipment.
All right, let's also talk about your portfolio focus right now because we are looking at a revival in demand. Rural had already gotten pace, but then there is somewhat recovery even in the urban markets. Having said that, second half of this year is very crucial as far as consumption is concerned, as far as that particular theme is concerned, which a lot of experts are also bullish on. What will be your take in terms of demand recovery? Because the entire scenario is also very positive. We've seen a front loading of rate cut. We've also seen the EMIs gone down. So there is a lot of spending. How are you analyzing this in terms of your sector specific choices as well?
Yeah, so it's been one simple thing has been we prefer local to global because even before this additional 25% came in, there was already, talks. So Trump had put 25% on India. So to that extent, it was, the domestic economy will be relatively better. Within domestic, if you think of consumption, like you rightly pointed out, there are three factors which probably will help consumption this year. So one is the tax breaks, which is like 1 lakh crores, which was given in the budget of this year. The second is, the monsoons have been good, crop is good. So to that extent, farmers will be better off. And third is EMIs are coming down with interest rates coming down. So now, have we seen this reflect already in demand? Probably not, but hopefully by the second half of this year, the demand will come through. Second is if we look at, the investment side, government has accounted for a bulk of the investments since COVID. And probably government investment cannot go at the same pace it's going. It used to grow at 20-25%. We'll probably see it going now closer to 10-12%. At the same time, private sector is not spending as much as we wanted to. But if we analyze the listed companies, and we have done a report on that also, that probably since FY22 to FY26, which is in 4 years, the listed companies' corporate capex will double, which is like a healthy pace of growth. So you're starting to see some corporates starting to put money into capex, and that will probably help investment demand. So overall, it's like a mix of investment and consumption, which we'll see. And like I said, there's some sectors which are export, which probably are not as impacted by the tariff as, a lot of the other sector like textiles or gems and jewelry.
Sure. Keeping that aside, just let's just focus on the BFSI space. Now, what's interesting for you? And specifically talking about banking, are you tilted more towards the private banking space? What will be your view on PSU banking as well?
Yeah, so when we look at the banks, basically we tend to look at, whether it's public or private, we tend to look at the nature of the banks. So whether it's a corporate bank, retail bank, and that is the way we really break it more than public and private. So for us, this year is a year where the first half of the year you'll see NIM pressure coming. And so, the more banks which have like a fixed loan book, they'll probably be better off than banks which have a variable loan book. And as we move into the second half of the year, we'll probably see some of the NIM pressure easing off because the lead lag effect will start to play out in the favor of these banks. So essentially for us, it's been, early part of this fiscal year, you're buying banks where, there's a fixed rate book, but slowly as we move into the end of the year, we'll probably be changing our stance. Overall, when we look at it, there are some banks which look very cheap, given where the credit growth is going for them, where the ROA and ROEs are going. Many of them happen to be the private sector banks, but there are some public sector banks also which are on our radar, which probably can do interesting work.
Sure. I also want to know your view on the IT sector now. Having spoken to a few experts, a few of them think that, focusing more on the tier 2 and tier 3 type of IT companies would make sense for mid to long term. Definitely, there'll be a short term impact on all the counters as far as IT is concerned. But then, having said that, what is going to be your strategy, or what are you banking on? What kind of pedigree? And definitely, the exposure matters.
For us, IT is something we've been underweight for a long, long time. And so, it's both short term as well as long term. On the short term side, the US economy is not looking great. So if, the US economy starts to weaken, then the demand for the IT companies will weaken. I think the visibility on future growth is limited. Uh, at the same time, longer term, the worry is just this, artificial intelligence and what it does to the demand for the IT people. It's possible that we don't grow for some because AI will keep taking away some of the jobs which the IT people in India do. So that's the reason we've been underweight. But relatively, yes, between the IT companies, we would prefer some of the smaller tier two, especially people who are into some niche sectors which are less vulnerable to IT and stay away from a lot of the larger names.
Any specific concern do you have as far as FII is pulling out 4 billion from 5 specific sectors which are also under the pressure now? Should one also be joining the selling spree and just revamping their portfolio given this kind of a trigger?
So, the FI selling is, partly because of, more relative rather than absolute factors. So if we look at India today and when anybody looks at it within the emerging market space, the problem is India is very expensive relative to most of the other emerging markets. So we trade at close to 80% PE premium to, what emerging markets trade at. And that's the reason we are seeing, some money move away from India into a lot of the other emerging markets. Also, what you have to remember is this premium could be justified if earnings were very, very strong. Then you can say I'm paying a premium because there's very strong earnings growth. But for the last 4, 5 quarters, basically earnings growth has been single digit. In fact, it has been mid single digit rather than even high single digit. So to that extent, India is not standing out that it's like a great place where there's, a lot of earnings growth which can justify the valuation. So, when one of the two things happen, which is basically, either you see earnings start to pick up or you see relative valuation start to contract, and that could happen simply because some of the other markets do better than what we do. That's where, the FIF flows will start to slow down, or the outflows will start to slow down. And, that's where probably things may stabilize a bit.
How do you make sense out of the earning numbers so far? It's a mixed bag, and kind of expectation of the coming quarters for you.
So, I think the good thing was we started with a very low expectation. So, to that extent, I would say the earnings have been nothing spectacular. They are like going to be 6% or something, which is nothing very exciting. At the same time, it's more or less in line with what the expectations were. So, I would say it's an inline quarter relative to the weak expectations we had at the starting. We think that from here, probably we'll see some recovery happening. And I would be expecting the second half to be more into double-digit growth rather than the 5, 6% we've seen over the last 5 quarters.
All right, I think that will be all. Thank you so much, Mr. Jaipuria, for taking
Thanks a
time
lot.
out and helping our viewers with it today. Thank you.